Here is something that should not be possible. You take the 30 most celebrated stocks in America, the ones the experts decided are too weak to stay in the most famous stock index in the world, the ones getting fired from the Dow Jones Industrial Average. And those stocks, the rejects, the discards, the fallen, beat the replacement stocks. Not once or twice, not in a weird year, but in 32 out of 50 changes, going all the way back to 1928. And by beat, I don't mean by a little. $100 put into every deleted stock from the Dow since 1928 would have grown to $3.3 million by 2006. The same $100 invested in every replacement stock, the darlings, the hot picks, the ones the committee chose, would have grown to just $160,000. That's not a small edge. That's a 20-fold difference. By the end of this video, you'll understand exactly why this happens, and more importantly, what it means for how you think about every investment decision you make. And just to be clear up front, nothing in this video is financial advice. This is educational content, and you should always make decisions based on your own research and circumstances. Let me take you back to November 1st, 1999. The dot-com bubble is still inflating. Home Depot is everywhere, opening a new store literally every 56 hours. Sears, the legendary American retailer, the company that once sold houses through a mail-order catalog, is struggling. The Dow Jones Committee makes its decision. Sears is out. Home Depot is in. At the time, this looks completely obvious. Sears stock had fallen nearly 50% in the previous 6 months. Home Depot had risen 50%. One company is clearly dying. The other is clearly thriving. So of course the committee picks Home Depot. Of course investors agree. Everyone knows Home Depot is the better company. But here is what actually happened next. If you bought Sears stock the day it was kicked out of the Dow and held it until Kmart acquired it 5.5 years later, your total return would have been 103%. If you bought Home Depot the day it was added, you would have lost 22%. The S&P 500 during the same period, down 14%. So Sears, the loser, crushed the market, and Home Depot, the winner, underperformed. How is that possible? That question is what this video is about. To understand what's really going on here, you need to understand one of the most misunderstood forces in all of statistics. It's called regression to the mean. And almost nobody, including highly educated finance professionals, truly internalizes it. Here's the simplest version of the idea. Imagine 100 people take a history quiz with 20 questions. Some people are genuinely strong, some are genuinely weak. But everyone also has good days and bad days. The person who scores in the top 1%, they're probably talented, but they almost certainly also got lucky, remembered a fact they might have forgotten, happened to study the right topic the night before. Now ask that same person to take the test again. Their score will almost certainly be lower, not because they got dumber, but because the luck that pushed them to the very top is unlikely to repeat. And the person who scored at the absolute bottom, they'll probably do better next time. Not because they trained, but because their unlucky day probably won't happen twice in a row. This tendency for extreme performances to drift back toward the average on a following measurement is regression to the mean. Now here's the critical insight. Regression toward the mean happens whenever performance is an imperfect measure of underlying ability. And in the real world, almost everything is an imperfect measure of underlying ability. Test scores, athletic performance, corporate profits, stock prices. This idea was so poorly understood that a statistician named Horace Seacrest once spent 10 years compiling over 400 pages of data to prove what he called the tendency of mediocrity to assert itself. He studied hundreds of companies. He found that the most profitable companies in 1 year tended to be closer to average a decade later. He concluded this was a deep truth about competition in economics. A brilliant statistician named Harold Hotelling read the study and politely but devastatingly pointed out that Seacrest had spent 10 years proving nothing at all. What he observed was pure, automatic regression to the mean. It required no economic theory, no competitive forces. It would have happened no matter what. If you don't understand regression to the mean, you will misread the world. You'll think that improving students are responding to tutoring when they were just having a bad day. You'll think struggling athletes are collapsing under pressure when they were just at the tail end of a lucky streak. And you'll think deleted Dow stocks are permanently broken when they might just be at the low point of a natural fluctuation. Now let's bring this back to the Dow. The Dow Jones Industrial Average, most people just call it the Dow, is a collection of 30 blue-chip stocks meant to represent the most important, most stable, most admired companies in America. Periodically, a committee reviews the lineup and makes changes. Sometimes a company gets acquired and simply disappears. But sometimes, and this is the interesting case, a company falls on hard times. Revenue drops, profits shrink, the stock slides, and eventually the committee decides this company no longer belongs. Think about what that means. By the time a company gets deleted from the Dow, everyone knows it's struggling. The analysts know, the fund managers know, the retail investors know. And that knowledge is already baked into the stock price. That's why the stock is cheap. Now, think about what happens to a company that gets added to the Dow. It's been performing brilliantly. Revenue is up, profits are soaring, everyone loves it. And again, that knowledge is already reflected in the stock price. That's why the stock is expensive. Here's the question that actually matters for investors. Not which company is better right now, but which stock is a better investment going forward. And that's where regression to the mean changes everything. The company being deleted probably isn't as broken as it looks. Its recent poor performance almost certainly contains some bad luck. A bad macro environment, a one-time write-off, a temporary product failure. When that bad luck normalizes, the business recovers. And a stock that was priced for catastrophe delivers a pleasant surprise. The company being added probably isn't as spectacular as it looks either. Its recent stellar performance almost certainly contains some good luck, perfect timing, a tailwind from a booming sector, a year when everything went right. When that good luck normalizes, the business slows, and a stock priced for perfection disappoints. Gary Smith, a professor of economics, documented this pattern in a comprehensive study of all 50 Dow changes going back to October 1928, when the 30-stock Dow began. The result? Deleted stocks outperformed added stocks in 32 of those 50 cases. Over the full 78-year period, a portfolio of deleted stocks beat a portfolio of added stocks by roughly 4% per year. 4% might sound modest, but compounded over 78 years, and you get that staggering difference. $160,000 versus $3.3 million. Now let's look at the most dramatic single example. Year 1999. 4 substitutions at once. Out. Sears, Goodyear Tire, Union Carbide, Chevron. In. Home Depot, Microsoft, Intel, SBC. Home Depot, Microsoft, Intel, SBC. 4 iconic American companies at the peak of the dot-com era. If you had put $2,500 into each of the 4 additions on November 1st, 1999, $10,000 total, and held for 10 years, the addition portfolio was down 34%. If you had instead put that same $10,000 equally into the 4 deleted stocks, the deletion portfolio was up 64%. The S&P 500 over the same decade, down 23%. The boring, discredited, embarrassing deletion portfolio didn't just beat the additions, it beat the whole market by a lot. Let me tell you about a mistake made for years inside the Israeli Air Force. When a trainee had an exceptional flight, instructors praised them. On the next flight, that trainee almost always performed more ordinarily. Conclusion: praise makes pilots complacent. When a trainee had a terrible flight, instructors came down hard on them. On the next flight, that trainee almost always improved. Conclusion: criticism works. They were wrong about both. Daniel Kahneman, who would later win the Nobel Prize, sat in on one of these debriefings and immediately saw what was actually happening. Exceptional flights contain genuine talent and good luck. Bad luck doesn't last. Neither does good luck. Both groups were simply regressing to the mean. The instructor's response had nothing to do with it. Kahneman called that realization one of the most important insights of his entire career. Now, bring that back to the Dow. Home Depot, rising 50% before joining the Dow. Sears falling 50% before getting cut. Both moves contained real signal and temporary noise that was already close to reversing. The analysts who thought Sears was finished weren't stupid. They were just doing what human brains naturally do. We see patterns everywhere, even in random noise. We build confident narratives around cherry-picked data. We mistake good timing for good strategy. And we forget that extreme results are inherently temporary, not because of mystical forces or competitive dynamics, but simply because randomness fluctuates. We've established that the rejected stocks beat the celebrated ones. But here's the question that actually matters. Can you use this? And should you? That's where we're going next. At this point, you might be thinking, okay, but if this pattern has been known and documented, haven't investors already traded it away? That's a fair and important question. Whenever a reliable market anomaly gets widely publicized, smart money tends to flood in and arbitrage the opportunity away. Think of the dogs of the Dow strategy, buying the highest yielding Dow stocks, which worked for decades until it became too well known. The honest answer about Dow deletions is, we don't know with certainty whether the edge persists in the same magnitude. What we do know is that the underlying reason for the effect, regression to the mean, is permanent. Regression to the mean will never be arbitraged away because it's not a market inefficiency. It's a mathematical property of how noisy signals relate to underlying reality. As long as stock prices respond to recent performance, and they always will. Recent performance contains luck alongside skill, and it always will. Extreme performance regresses toward average over time, and it always will. Then stocks priced for disaster will, on average, outperform stocks priced for perfection. That's not a trading strategy. It's almost a law of nature. What this means practically is about temperament, not timing. It means being suspicious of obvious momentum. The stock everyone agrees is broken, and the stock everyone agrees is a guaranteed winner. It means recognizing that the financial media's job is to tell compelling stories about why a company deserves its current price. And those stories are almost always backwards looking. And it means developing a healthy skepticism for any analysis that doesn't account for how much luck was baked into a recent result. So, what does all of this actually mean for you? Let me give you 3 concrete things to take away, regardless of where you are in your financial life. Takeaway 1. Be skeptical when everyone agrees. When a stock gets added to the Dow, it has been publicly anointed as one of America's 30 most important companies. Media coverage is celebratory. The narrative is airtight. Everyone agrees it belongs at the top table. But that moment of universal agreement is often exactly when the easy gains are already behind the stock, not ahead of it. The company may be genuinely great, but at the price you're paying, you might be buying someone else's good luck. That applies whether you're building a portfolio in your 30s or rebalancing one in your 50s. Chasing what's recently been celebrated is one of the most common and most expensive habits in investing. Takeaway 2. Don't reflexively avoid fallen companies. If you're a more experienced investor managing a portfolio through your 50s or into retirement, this matters differently. You're probably not looking to take big swings, but you might be making the mistake of rotating out of sectors or positions simply because they've had a bad run, and rotating into what's been working. That is, in many cases, the mathematical opposite of what produces long-term returns. The question is never, what has done well recently? It's, what is priced well relative to its actual long-run prospects? Takeaway 3. Separate stories from statistics. The financial media's job is to tell compelling stories about why a company deserves its current price. Those stories are almost always backwards looking. They explain what already happened. They don't tell you what comes next. And the more confident the story sounds, the more everyone agrees, the more likely it is that the price already reflects everything the story is saying. Whenever you hear a confident financial story backed by a chart, ask yourself, is this a real signal, or is this what regression to the mean looks like from the inside? Here's the one thing to carry with you after this video. The market is brilliant at pricing what everyone already knows. What it consistently misprices is the difference between genuine ability and temporary performance. The stocks getting thrown out of the Dow aren't necessarily dying. The stocks getting added aren't necessarily destined for greatness. They're just companies at different points on the same curve that eventually bends back toward the middle. The investors who understand that really understand it, not just intellectually, but in how they react when a stock is cratering or soaring, are the ones who avoid the most common and most expensive mistake in finance: buying the story instead of the math. If this got you thinking, the deeper question is one of the hardest in all of investing. How do you tell the difference between a company that's genuinely broken and one that's just had a run of bad luck? There's no clean answer, but understanding regression to the mean puts you miles ahead of most people who never even think to ask the question. Drop your thoughts in the comments. Have you ever sold something at the bottom or bought something at the top and realized later it was just regression catching up to you?